Hello everyone. So this is a part 2 of my video on partnership. Today we'll learn about how do we make adjustment of partnership account in balance sheet, and also look into what do you mean by change in partnership and what are the different things that we need to take into consideration before we proceed into accounting. So let's get started. So in our previous class, we understood how partners should maintain their capital account. So one is making it using the fixed capital method where capital amount does not change. And another one is fluctuating capital method where capital account changes every time when we give our share profit or losses using appropriation account. So now, here is the sample that I have made from our previous video. And this was particularly made when partnership account maintain fixed capital method. Most of the time in your examination, they will ask you to prepare separate account to maintain capital account as fixed. So in this case, we have made capital account, we have made the capital account and current account. Okay, so as soon as you see current account, you have to assume, or it means that capital is kept in fixed method. Okay, capital does not change. So in that example, we saw that partner's capital has 20,000, okay, for partner A and 30,000 for partner B. So this is how you write down in balance sheet. Under equity and liability section, and under equity or capital, first we write down capital account and name of partners and their capital. So in this case, partner A is 20,000, partner B 30,000. We add it together, we'll write down 50,000 in the second column. Similarly, on current account, we had a balance of 76,800 and 73,500 for partner B. So we add them together, and then we write down the total on the second column. Now, this 50,000 from capital account and this 150,150 from current account, we add them together here, and then we write down that in the final column out here. Okay, so this is the format of how do you record capital in balance sheet. So capital has two parts, capital account and current account, and this is how you're going to write down. Now, let's talk about change in partnership. Okay, so change in partnership can cause by three different ways. First one is when there is a change in partnership agreement. Okay, so if we are the existing partner and we thought that partnership profit sharing ratio or any of the agreement is not right, or we want to make changes, then if we made that changes, we call it there is a change in partnership. Okay. Another one can happen when we want to admit a new partner in our partnership, or if any existing partner retires from partnership. So in these three circumstances, partnership changes. Okay. And when partnership changes, we need to divide year into two halves, before the change and after the change. Okay, because it is not always possible to change the partnership at the beginning of the year or at the end of the financial year. So sometimes it can happen in between the year. So we need to divide the year before the change and after the change. We'll look into some problems and then solve some questions based on that. But for now, just understand that when there is a changes, year has been divided into two halves, before change and after the change. Now here, these are the proceedings that we had to do when there is change in partnership. So first one is, we need to prepare account called revaluation account. Okay, so the revaluation account is prepared to distribute or transfer profit or loss arise due to increase or decrease in the book value of assets and liability during the change in the profit sharing ratio, admission of partner, retirement of partner, or death of the partner. Okay, so in any of this case, when there's a change in partnership, we need to prepare a revaluation account, And revaluation account revalues all the assets and all the liabilities. And if there is a profit or losses arises in that case, it needs to be given to the partner, okay? And that is done through the help of revaluation account. And it is mandatory for us to prepare revaluation account when there is a change in partnership. Now, the second thing that we need to do when there is a change in partnership is revalue or value the inherent goodwill. Now, it is not mandatory in case of changes in the ratio or changes in the agreement of existing partners, but it is important that we do this valuation when we admit or partner retires from the business. Okay, so I particularly mentioned this term here, okay, called inherent goodwill. And there's a reason, okay? Because goodwill can be of two types. So in this next slide, we'll discuss that. So there's a purchase goodwill and there's inherent goodwill. Now the purchase goodwill means when we buy another business and we are paying higher sum or higher value than is fair value, okay? So let's say business has a value of altogether 50,000, but if we end up paying 60,000, okay, so this 10,000 extra that I'm paying is actually goodwill, okay, or for the goodwill. So it is called purchased goodwill. Now, inherent goodwill is type of goodwill which is internally generated, okay? And it is basically earned by the business because of its reputation, okay? Sometimes that goodwill is positive or it could be negative as well. So if business asset is, let's say, 100,000 and its liabilities are, let's say, 40,000. Okay, so the value or the fair value of the business is actually 60,000 here. Okay, so we can say this is the book value of the business. But now in this case, if we purchase this business, then business would demand some extra money than the $60,000. Okay, so in that case, if we are paying them, let's say, $75,000. Okay, so this 15,000 extra that I'm paying, is the amount of goodwill. Okay, so this is your goodwill. Okay. And this goodwill is the purchased goodwill. Now about the inherent goodwill, we have various methods to calculate inherent goodwill. Okay, those concepts are not in the scope of our syllabus, but I can just show you what are the different methods of calculating inherent goodwill. Okay, so it is average profit method, super profit method, capitalization method, annuity method, and we don't have to learn all that because in our examination, if there's an inherent goodwill, then they will give us what is our inherent goodwill, okay? So before we admit the partner, this is the amount of goodwill business has. Or before the retirement of existing partner, this is the amount of goodwill we calculated for the business. So we don't have to calculate inherent goodwill, it will be given to us. So it is not in our scope of our syllabus for ACE and A level or ICSC or IGCSC or CBSC. I'll see you next time with the new video. Thank you so much and have a nice day. Bye.